looking to sort of anchor above $91, having closed last week just above 90. So we have moved on from last week, and this market seems to be ultimately moving in one direction. Of course, we had the news overnight of yet more a third round of sort of missiles coming from Yemen into the UAE. These are sort of a series now over the last week, unprecedented in modern times that would happen, clearly adding to the geopolitical risks around the world. Let's kick off Monday morning, as always, with Omar Najia, a global head of derivatives of BB Energy. Omar, your thoughts this Monday morning as the market looks quite tight, combined with this geopolitical risk now?
Yeah, so I don't think very much has changed, to be honest. The UAE's already said that they've actually pulled back their forces in Yemen. So I expect this is just a kind of a flyby, kind of a hello from the Houthis, just to make sure that nobody has any other ideas. So that's done and dusted. The Fed is gone, so the Fed is also done and dusted. So there's not a lot left. So basically, markets are the oil market is trending. So I think basically higher. So into March, after March, I'm not at all friendly to this market. But between now and March, it's pointless to pick it up. All we got to do basically is the trend is your friend, and up we go. So I have this argument. So I had this argument here in the office on Friday. So people are saying, take the money. And the point is that, things like this don't happen often. So no, you don't take the money. You stay and you add to your positions, and you keep adding to your positions until the market comes and slaps you across the face and says, too much, and that's it. But you don't take your money, you don't turn tail, you don't say, I think that, $91 Brent or $100 Brent or whatever dollar Brent. You wait for the market to prove you wrong. So I think I will hopefully be able to add to stuff that we have, and you push it and you keep pushing it until the market proves you wrong. When we get to something like, end of March, early April, sometime in Q2, then I think, I would not be long the oil market. And on equity markets, everybody's been saying, Fed raises interest rates. If you look at data, Fed raising interest rates does not mean markets come off. It's basically a myth. So I like the equity markets. I like the fact that people are scared. I like the fact that the media keeps scaring people. It's the same like with this Russian stuff, right? They say, you go back to Evergrande, China's going to collapse, but nothing's happened. Russia has been about to invade Ukraine for 3 months now. Nothing's happened. So it's the same with equity markets. They'll scare you. They push the market down, I think 9.5%, 10% from the highs. It is not time to sell. And that's the view. Gold, I still don't like it. I never, it's not a thing for me. So that's it. Let's see what happens.
Amina Bakr, good morning. Happy New Year. Deputy Bureau Chief and Chief OPEC Correspondent for Energy Intelligence. Amina, it's great to have you back at the table in a week in which OPEC is yet having another monthly meeting to consider further increases in their supply. What is your expectation of the decision that they face this week?
Hi, good morning, Sean, and Happy New Year to you too. Yeah, we're seeing prices touch $90, and as Omar pointed out, there is one trend that's very clear: it's going up. But so far, what I've been hearing from OPEC Plus officials is that this rise in prices isn't really due to the fundamental factors. It's nothing to do with supply shortages. These are factors beyond the group's control. As you mentioned, these attacks on the UAE are part of it. Geopolitical tension in the region, uncertainty about reaching a nuclear agreement, the US reaching a nuclear agreement with Iran. So all of that contributes to where prices are. The group don't feel that they can do much really at this point. Their spare capacity is eroding really fast. The assessments we have now is that spare capacity among OPEC Plus is about 2.5 million barrels. So theoretically, even if
across all of OPEC Plus,
all of OPEC Plus, and there are only a few members, I would say Saudi Arabia and the UAE, who could immediately add production, and that production could be sustainable. The rest, it's going to take some time to add these barrels into the market and to keep it at a sustainable level. Therefore, I mean, theoretically, even if they come out and say, we're going to increase more than the 400,000 barrel per day increments, the market isn't going to be looking at that increase. They're going to be looking at the spare capacity, which is being eaten up. So it's a double-edged sword for them. So I believe, and what we've been hearing so far, is that they're going to keep policy steady, continue with the 400,000 barrel per day increments, and not really rock the boat in terms of the delivery, as we all know that this 400,000 hasn't been delivered due to some countries not being able to meet their quota. I think they're not going to go into the discussion of who can't produce what and other countries with substitutes. That's not going to happen. It's just going to be the same for the time being.
Good morning, Mark Ostwald, Chief Economist and Global Strategist, ADM Investor Services International. Thank you for coming back and Happy New Year, Mark. Omar made the point that all the scaremongering of the media and that China is going to collapse or whatever was the reporting. Ultimately, China has stumbled, and it is clearly one of the sort of demand concerns for 2022. Your thoughts, Mark, as we sit on the last day of January, oil prices up 17% this month.
Well, let's talk about China a little. The China factor is less of a factor, I suspect, with oil, from the aspect that one always has to look with China's resource buying. At the moment, I would exclude the whole iron ore steel sector because that's obviously a factor due to something else. But other than that, the Chinese aren't stupid. They try and buy low and sell high, and they restrain themselves. And this has been, there's a long track record here. So you're taking Chinese demand for oil, as a sort of like a measure of what the economy is doing. I don't think it's particularly wise. The better indicator, I think, for people if they're looking in terms of the oil sector and China and the Chinese economy is to have a look at how much are they having to re-export because of product. Are they having to re-export for, because the domestic demand is weak? That's definitely the case. China's economy is definitely stumbling. There's no question about it. And in broad terms for the commodity markets, it is actually going to be a very important picture. But at the moment, I think actually, because most Western economies are still not going full tilt in terms of their industrial sectors, simply because of all the disruptions from COVID, because of the other supply chain bottlenecks. So underlying all of this, we've got a situation, the thing which worries me, which has already been referenced in terms of output by OPEC Plus, but more importantly, in terms of product, we don't know how much productive capacity has been lost from the global economy. And this is absolutely critical because that lost productive capacity is what is driving inflation. There is simply, we have no measure. We have some vague ideas in the States. Roughly 10% of US refining capacity has gone offline permanently. That obviously makes a huge difference when they get any disruptions, whether it's via cyber attacks or weather events, it doesn't really matter. So the underlying picture is one still of everything being driven by supply chain disruptions, which aren't going to go away this year, to my way of thinking.
When you look at that, Mark, from the point of view of prices, consolidating above $90 on the open this morning in Asia, at a time when we've had the IMF come out to say that global economic growth is revised downward, We have this China stumble, and the Chinese numbers this morning showing the impact on builders and the construction sector from different factors, and in manufacturing. Although they avoided contraction in January, they were certainly down in terms of the PMI. So my point is that ultimately there's a lot of this sort of bearish news that you would typically think would put some downward pressure on this oil price, but yet no, it keeps moving north. Is that purely the geopolitical risk premium?
I think it's two factors. One is definitely geopolitical risk premium. That's definitely going to be the most cogent one this week, particularly with China on holiday for the Lunar New Year. I think the other one is it's momentum. This is a market which is still underpinned by a lot of central bank liquidity, and momentum trading is absolutely the number one thing at the moment. So everyone's looking at the oil market, to a certain extent, a lot of other commodity markets, and saying this is a great momentum trade. And then you go back to what Omar was saying to start with. Don't abandon the trend, because the momentum traders will keep pushing it until something comes and hits you in the face. And the geopolitical factor within this is basically saying, well, do you really want to suggest to me that those tensions, that you've got in the Gulf with all the bombings going, or attempted bombings going on, and the tensions between Russia and Ukraine, it's not going to go away in any great hurry.
It's not a sell window. But Omar, the point of this sentiment sort of wave, if you like, all boats rising, I thought we were of the view that period was over, or is it still underpinning this market as Mark suggests?
No, so basically, on technical perspective, if you look at this market technically, then I think we're in a fifth wave. We're in a last terminal wave up, and basically the thing about these things is you don't want to front run it. So, you basically make money while the money's there to be made, and you don't worry about when it's going to basically end. So basically people will say, look at fundamentals, I've got 3+ here and 2+ there. Therefore, that means this. And the market's just going to buy until people who rely on the fundamentals cover, and they're wrong. And then they're going to say, yes, it's the geopolitical stuff. I know, the market knows, nothing's going to happen with the UAE. Absolutely nothing. Nothing's going to happen with Russia. Absolutely nothing. Zero, right? Everybody knows that. So basically what it does is it attracts people who say, I'm going to sell because this and this and this, or I'm going to buy. It's got nothing to do with this. It's basically purely to do with sentiment, purely to do with the most pain is to the upside. We are never going to get above 90. We are never going to go higher. With all the bearish news, that surely it's going to come off and all the rest of it. It's going to keep going up and going up and going up until you get this, again, what I talked about a long time ago is this kind of Wile E. Coyote moment where basically, he looks and then looks down, then looks at you, and then he waves and he goes down. So that's coming. Personally, the only thing that I can say is it's coming towards the end of March. But do I think it's coming now? I don't think so. Is it possible? Yes. But you get the ball, you run with it. You don't basically start saying, well, we might end.
You seem to dismiss the outlook or the impact for the Fed tightening, and the idea that I think the element of the Fed tightening that might have spooked the markets, not just the journalists, but ultimately the people who manage money, that the accelerated outlook of this hawkish acceleration, where we went from no rates to now Goldman Sachs forecasting 5 rate rises, that amount of tightening, that sort of sharp slam on the brakes that could even, if the trend continues from no rates a few months ago to 5 now, we could end up with 7. What's your thoughts on that
I think in 1984 or 1987, I'm not sure which one, the Fed raised rates 35 times. You know what the market did? Went straight up. Okay, so raising
crashed
rates
in 87.
Well, I mean, maybe it was 84. I'm
Black
not sure,
Friday, whatever it was.
Yeah, but basically the problem with these things is there is no correlation between one and the other. Nothing says. So what they do when they raise rates is they basically remove money from the markets. They take liquidity out of the markets, right? So they take liquidity
I mean,
They bought
ultimately,
bonds.
they reduce the profitability of companies and hence their price earnings ratio, right? I mean, if a company has to pay more money in debt, it's less money they can give out in dividends. I mean, that's
No,
the
no, wait.
basic principle.
Well, wait. It basically depends if you're talking about interest rates and what companies pay and what the lines are and how much they pay for that. That's totally different. So, bottom line is the Fed, by increasing rates, if you like, all they're doing is draining liquidity from the market, right? So, like it's a big bathtub full of like lots of free money. So the Fed is going to come and say, we're going to take a cup out, and everybody's like, oh my God, it's a cup. But the bathtub is still full. So you could look at it whichever way you want. It's a bathtub full of liquidity. The Fed, all they're doing is draining it. They're going to drain it slowly. They might do 1 cup full, they might do 5, but it's a bathtub. You can.
I think it's a swimming pool, actually. Amina, sorry, let me just go to Amina on this point. OPEC sitting in and making a decision. I mean, I would say, listening to Omar and I think to other commentators, that the Fed has lost control of this, bathtub, so to speak, if indeed they're won control of it. Their credibility, in my opinion, they're behind the curve on this with 7% record inflation for 30 years and all the other stuff. But OPEC also seems to be, the other central bank of oil, sort of moving potentially into a credibility challenge, given they've committed, they keep announcing 400,000 barrels a day of supply increase and not meeting them. And I'm wondering, from the point of view of discussions within the group, is there any sense that that is becoming an issue of concern? I mean, we had the Saudi minister last week very categorically declare that they would not be making up any shortfalls from anybody else. I'm wondering, from that point of view, the credibility of OPEC to keep announcing a number that they just don't get anywhere near meeting.
Yeah, it's a good point you made, Sean, and they're not actually delivering the 400,000 barrels per day, but I think they're building their credibility on the fact that during a time where the market is so volatile, you have so many moving parts, and they're able to keep a steady hand on policy. Consistency is what they think they're bringing to this environment. And as I said before, their hands are tied, really. They can't just suddenly announce more increase of supply without people looking at the dwindling spare capacity. So they're very limited in what they could do. But what I want to ask Omar too, there's a fear that, nobody at OPEC Plus wants to see $100 oil. Of course, that leads to demand destruction. And we haven't heard of demand destruction yet being said in Asia and other parts. But there is a fear that if oil goes to 100 or above, we're going to see a crash in the global economy, a market crash, that we've seen in 2008. So I want to ask Omar if this is a possibility.
No, I don't think so. So if you look at the world now, and you look at the US with the Green Deal, and you look at Europe with zero carbon by 2030 or 2035 or whatever it is, they want prices higher. Why? Because who's the biggest user of energy in the world? It is not Europe, the US. It is basically the growing economies in the East, so they can put pressure on them. The US has its own oil. If prices skyrocket, the people who will be hurt are basically economies in the East, not Russia, China, India, these economies, they'll be badly hurt. So I think they need prices higher because they need to justify the price of green energy, the price that people will pay for their electricity at home, and politicians need to justify that. So if oil prices are at 100 or 120, they say, look, this is OPEC's fault. If they don't have that, then how can they explain to people why they're paying so much more for the electricity?
So you think that's the tipping point into the transition, basically?
Yes, and I think basically, will it affect people's ability to spend? No, because what's that term they use? Disposable income is massive. So no, the oil prices are so cheap in real terms, in terms, relative terms to everything. No, I don't think you'll see any demand destruction. And demand destructions for oil It's not a luxury, it's a necessity. So people will drive, people will heat their homes. Demand is inelastic against price, is my opinion.
Mark, I wanted to get your view on the issue in the Ukraine and in Europe. Obviously, you sit in the UK, but you're very well connected to Poland as well. What does this crisis look like? Are you as sort of bearish? I don't know if that's the word, but Omar is basically his view that nothing's going to happen, nothing to see here. Your view from Europe on that, as to because the headlines of the politician are clearly selling this as a major crisis.
Yeah, the politicians will necessarily sell it as a major crisis, and I would actually sadly have to accuse most of the politicians of trying to distract from their mismanagement of the whole reaction to COVID, because it is a convenient distraction for them, sadly. I think the problem in Europe really is that there is a lot of fear, particularly in all the countries of Central and Eastern Europe, in the Baltics, in Poland, in the Visegrad group, about what this might mean. They've always been fearful of Russia, and that's always been, that's not going to go away. It's actually built into their genes because of the experience. In terms of what Europe's doing, I think the real worry here is actually Europe's not singing from the same hymn book. Germany is completely and utterly at odds with the rest of NATO. It looks farcical in terms of what it's doing. And there is a whole credibility issue on that front. And that only actually amplifies people's fears, because they look at Germany and say, well, you're just going to appease the Russians. And so that will make just Putin do more. But I do agree with Omar in the sense that Mr. Putin is literally just pushing. And really what he wants to do is make the US and the whole of Europe look very, very weak. And China, in that sense, and Mr. Putin and Mr. Xi are meeting in the context of the Olympics at the end of the week, which is going to be an interesting one, is looking on and saying, wonderful. That's also partly distracting from our tensions with the US. Anything which acts as a distractor is wonderful. And I think that's the sort of part of the political narrative that's there. People, I think in Western Europe, people are basically of the view, well, nothing's really going to happen. It's a little bit unpleasant. People in Central and Eastern Europe are of, on the street, a different view.
I mean, ultimately, the noise around it, I mean, everybody can have their view on it. It has its realities. It's not just a view, I suppose. Ultimately, this is a conflict of perception at the moment. It's a conflict of power, projection. Whether it's actually bullets and bombs is the next layer, but ultimately, this is already a face-off of some description. Let's get the survey question in and let everybody else have a view here on this price hike and where we're going next. Oil prices rose 17% in January. What will happen in February? Keep rising, drop off, or essentially flat? The view in the room. If we saw another 17%, of course, we would be over $100. So that is the destination, perhaps indeed, if we do keep moving. Omar, in terms of the momentum on this and the idea that there is a geopolitical risk premium in the oil price, we had a graph up earlier in this call. I'm not sure if Irene still has it, about how many dollars in the barrel might be currently inflated by geopolitical risk. Do you have any view on that? Is that just another non-technical that is that could evaporate, not evaporate from this price?
No, I really don't think there is any geopolitical price in oil right now. If you look at what NATO said, NATO's saying that Russia has 100,000 troops, right, about to invade. So basically, what's the response been militarily? The response has been Boris Johnson getting up and saying, we're going to double our forces and send from 800, they're going to be now 2 times 800, which is laughable. And then you've got the US, Biden, who's, probably somebody woke him up and he said, we've got 8,500 troops and they're going to be put on alert. So they're all waiting. They're kind of sitting down in their barracks and they're going to be on alert, 8,500 plus, 1,600 to do what? So if the threat really is 100,000, what are you doing exactly? So militarily,
but I mean, you're kind of contradicting yourself in a way, because all of those ingredients would indicate, if you're Putin, this is a green light. Why wouldn't I go to Kiev? I mean, it's like
because
there's 800
Putin,
British guys and there's a few Americans that are
I'll
got
tell
an
you
alarm
why,
clock.
because that's the problem with the narrative. Putin doesn't want Ukraine. Putin is saying, you guys keep it. You guys keep it because it's basically like a moldy bagel. You guys keep it. You eat it. You do what you like. Let there be, freedom and peace and all the rest of it. And you keep it. Putin has Donbass, has basically the energy, has the brains, has the educated people. He doesn't want the rest of Ukraine. You keep it. And the West is basically doesn't know what to do. So apart from militarily, like Mark was saying, politically, the Hungarians don't want anything to do with it. The Czechs don't. The Germans don't. And what's the big idea? To cut Russia out of SWIFT. I mean, for God's sakes. So Russia is talking. Who's Russia talking to? The US. It's bypassing the Europeans completely. They're apoplectic because Russia knows that Europe only does what the US tells them. So it's not even talking to them. And the Europeans, if somebody suffers here, it will not be Russia. And Russia has said, if you cut us off from SWIFT, you know what we're going to do? We're going to flip that switch, no gas for you. So what's going to happen? What's going to happen? You think Europe is going to sacrifice itself on the altar of, the Biden administration's blah, blah, blah? I think not. And
well,
if
clearly
they want
the
to,
Germans have indicated that they're more or less not willing to do that. And if there is to be sanctions to be not inclusive of energy, and it is for all of those reasons, I am not sharing your same sort of view that there's nothing to look at here. All the signals to me is green light for Putin, a green light for Russia to reclaim a territory that they've held for most of the 20th century.
they don't want it.
Well, I'm not so sure about that. Historically, it's been a very important place for Russia. Why wouldn't they want? I mean, what does want mean? They invaded Crimea. They've got the eastern province. Maybe they don't want the suburbs of Kiev. Who knows? But they clearly
don't want what's left.
They clearly want a big bite of Ukraine.
They've taken it.
They've certainly taken the pieces, and why not take some more? I don't know. Historically, they have. I think there's more to watch here, particularly because the Europeans and the Americans are so divided. But nonetheless, Amina, we're looking at the outlook for OPEC Plus. We are, as you say, getting closer and closer to the point in which there is declining extra capacity, and yet come April there is new quotas, more elevated. For five members to raise their quotas. Where is that connection point in terms of the ability for those five to meet those, never mind not meeting what we are doing now, but meeting the increases that are just around the corner? Because tomorrow's meeting, this week's meeting, is about March. And so after that, you're talking about the new quotas.
Yeah, I think at that point, Sean, they really need to revisit this whole quota situation again. Perhaps they need to go back to a system where they have a ceiling, a combined ceiling for the group to reach. Maybe that's a better system and would keep credibility intact. I really think that, I mean, of all the countries, we were mentioning that there are going to be five that have to increase their production. Saudi, UAE, maybe a Kuwait will be able to deliver on that front. I'm not sure about Russia, not sure about Iraq. I mean, consistently continuing to increase its capacity. But one point Gulf producers really want to make is, we talked about the tipping point, the point where some countries are saying oil is too volatile, it's time to switch to something else or invest in renewable energy. And these Gulf producers are hoping that the situation that we're in now, this tight capacity, the increase of oil prices, and renewable energy not being able to fill in the gaps at the moment, and it's getting more expensive with the inflation. They're hoping that policymakers would realize the importance of the upstream sector and invest more in upstream. So this is the way that they hope the current situation would translate.
Let's go to the survey result and give Mark the last word this morning. The survey result, a big bullish room with keep rising. Mark, keep rising, of course. Amina asked earlier of Omar the sort of demand destruction at these prices. We had India crying when we were briefly in the $60 zone. They've gone relatively quiet in recent times, but ultimately these are getting into big numbers for the burden of developing economies in Asia for that sort of OPEC plus critical marginal demand growth. How do you see that impact there going forward with this ever increasing oil price?
Yeah, well, I think that this is a broader cost of living crisis that we've got across the world, and it's it's Europe, it's Asia, it's the United States, and okay, so that part is not necessarily the biggest part of demand for oil, but there is a big risk of demand destruction here going on because consumers basically are now under such enormous pressure from all sorts of areas, all of which are non-discretionary. And as much as Omar said the demand is inelastic, well, I think particularly in the developing world, it's not so inelastic. And I think that's also true actually in Europe. Unless we see huge wage rises, which don't look to be on the cards for the time being, other than to cover skills shortages, which are enormous, and that's a different issue. No, I think the big risk is from overall demand destruction as we get all these price pressures piling on, both on businesses and on consumers.
Well, we included in our daily digest today a few stories about this energy stress that that doesn't include Asia, but we're seeing in Tanzania power outages announced. We've seen in New England the stress of the power system there and having to burn near record oil for power generation. Clearly, we know the story in Europe for some time that and we had also, I think, quite interesting interview with the FT and the Norwegian Sovereign Wealth Fund CEO talking about how this inflation we're seeing is bedding in and is going to be around for a while, and the impact that will have. So that sort of energy stress, I think, is spreading beyond Europe and could start to play out in other places as these prices continue to rise. But let's wrap it up there. Omar, as always, thank you very much for joining us. Mark from London, Amina in Dubai. Have a great week. Every morning, 10:30 UAE time, we'll be here again. Thank you so much. All the best and have a good day.